Wall Street thinks the crisis is over. Oil has fallen sharply, equities have rallied, the Nasdaq is back near record highs, semiconductor stocks have surged, and investors are once again celebrating the all-famous AI trade. But I think markets may be potentially drawing the wrong conclusions. So if we think about the immediate geopolitical shock potentially being faded, the Strait of Hormuz looking like it may reopen, energy markets potentially functioning again, that's obviously a positive development. But the bigger forces driving markets really have not changed. So the first is the Federal Reserve. We saw this week the Fed kept rates unchanged, but the real story was the messaging behind it. The market was expecting something more dovish. Instead, the Fed delivered a much more hawkish tone and signalled that inflation remains a key concern. So why does that matter to global markets? Because investors have become very accustomed to central banks providing extensive forward guidance and effectively telling markets what comes next. So the Fed appears very different in its stance now. The second force is artificial intelligence. Investors keep talking about AI as a productivity story, but markets are still rewarding the infrastructure build-out. So data centers, semiconductors, power generation, even networking equipment, memory, all the way to utilities. So the market isn't paying for productivity today, it's really paying for capital expenditure. And that capital expenditure cycle continues to accelerate. The third force, I think, is market concentration. So when the geopolitical risk faded or appeared to fade, investors didn't rush into small caps. They didn't rush into value stocks. They went straight back into AI. So I think that's an important signal. It kind of tells us that despite improving market breadth, a relatively small number of these themes continue to dominate global market performance. And so that's where I think the biggest risk remains to sit. The market is increasingly dependent on a handful of assumptions. That AI spending continues to rise, that capital remains available, that energy constraints remain manageable, and that inflation continues to fall. So those assumptions may ultimately prove correct, but they're also becoming increasingly important to asset pricing. So I think while Wall Street may temporarily be celebrating the end of the latest crisis, or the apparent end of the latest crisis, I think investors should pay close attention to the structural forces underneath the market, because the crisis may appear to have faded, but the regime hasn't changed. These views are mine and do not necessarily reflect those of the forum or any of its affiliates.